Let's get more right now from the Chief Investment Officer of Glenmede. That's Jason Pride. Jason, good to see you. Thanks for weighing in here. Your thoughts on the earnings season so far, GE included?
You know, first of all, thanks for having me on, Maria. And second, in terms of earnings, I think this is exactly kind of what we needed right now. 2018 has been more volatile, obviously, than it was in 2017. It's actually been running ahead of that pace throughout 2018, ahead of the normal pace due to concerns surrounding trade fears and possible trade wars. It's nice to have a reminder that fundamentals actually matter here, with earnings coming through for companies like GE and like many of the others. We're seeing actually a pretty good earnings season here, a confirmation of the ongoing economic and profit expansion that we have for businesses. And I think that should firm up support for equity markets a little bit and perhaps pull us back away from the higher volatility that we've basically been dealing with on a year-to-date basis.
Well, I mean, yeah, we're expecting 19% growth in earnings for the first quarter. So that's pretty good. But it's still been a volatile year, right, Jason? I mean, do you expect the volatility to continue? Do you want to buy stocks at these levels?
So we're recommending a relatively full equity allocation to our clients. Having said that, we do recognize that we are in the later parts of this cycle. The valuations have gotten a little bit more pronounced. And for that reason, we take a slightly defensive posture within our equity portion. So full equity weight, but defensive in that we're positioning with more kind of stable companies, some that are less cyclical in nature and less exposed to the economic cycle. About a 5% defensiveness, but not a dramatic defensiveness.
I see.
The key here, there, as you pointed out, is that 19% earnings growth number. Now, a good portion of that's coming from the tax cuts that are put in around year end.
Yeah,
but another portion of that is actually just from bottom line fundamentals.
That certainly has helped things, Gary.
Jason, I'm curious, though. On the one hand, you sound bullish. You sound like the economy's doing well. You respect the tax cut effect. On the other hand, you're a little defensive. So I'm wondering, when you get not defensive, are you all in and you say things are really robust and we're fully committed to the market?
Well, look, we're fully committed to the market, but we have to recognize, I think, in order to get really aggressive, I think we need to see lower valuations that allow a lot more upside in stock price movement. These higher valuations, we're sitting at 75th, 80th percentile valuations for the markets. That doesn't really leave that much more room.
Are you saying the market has to come down then, or the earnings estimates have to go up?
For us to get more aggressive, we think that the market would actually have to come down and be more fairly priced at this point in time. Earnings estimates going up. We're running at a pretty decent pace in earnings growth, and thus the reason that we're carrying a full equity weighting. But in order to get really aggressive, I think I'd have to see better valuations.
Yeah, I mean, Jason, these earnings numbers are great, but we've had this growth baked in for months and months. Investors have been expecting the boost from tax cuts. So there's nothing new here. There's nothing exciting. And that's why I think the reaction has been fairly muted from equity markets. I mean, this is exactly what we're expecting. Nothing new. Isn't that right?
I think that's right. I think we're at that stage of the cycle where we're at high valuations that are perhaps justified by ongoing decent fundamentals. And so long as those fundamentals stay in place, we'll probably have good equity gains, but not outsized equity gains because the valuations are already high to start. We're at that uncomfortable portion of the cycle where investors have to recognize that this cycle is probably going to run and keep going at high valuations, producing okay equity gains, but really putting them in that uncomfortable position about wondering when the downturn is coming. We don't see it in the near future. You know, we're trying to monitor it with things like a recession model that we put in place internally to try to get an idea as to what the chances of us actually seeing a more difficult environment are. Those readings are really low right now, which is what keeps us fully invested. But at the same time, we also recognize we're at the later part of this economic cycle. Valuations are relatively full. Downside risk is going to get more pronounced as we pace on through this, and we want to be mindful of that, and thus the 5% defensiveness. It's a fairly modest defensiveness. We could get a lot stronger on that if we saw real signs of possibility of a downturn, a more difficult economic environment. We're just not seeing that right now.
How much would the market have to come down for you to not be for you to think valuations are appropriate?
Fair.
Yeah.
Our models are basically showing the markets are about 15 to 20% overvalued right now. So I think we'd have to see a decline of that magnitude.
Wow.
Now, the way that could actually come about is that you could see stocks not keeping pace with earnings growth.
Yeah.
So stocks actually produce decent gains, somewhat decent single-digit sort of gains, earnings growth running in the 10, 15% range, and eventually bringing the valuations down just through the magnitude of difference between earnings and price. That could do it. So we could get there without a decline. I just don't think these valuations fully give investors an opportunity to get huge gains and huge returns at this point in time. So why jump up and down and take a lot of risk in portfolios? It doesn't seem to make sense.
All right, Jason. Thank you so much. Jason Pride, good to see you, sir.